One of the biggest things that separates a beginner trader from a pro, it's not their win rate, it's not the size of their account. It all comes down to how they answer one simple question. Where do you put your stop loss? Believe it or not, that answer reveals a whole architecture of thought, and today we're going to break down that blueprint.
Okay, so think about the last time you were in a losing trade. We've all been there, right? That knot in your stomach, that little bit of hope, just wishing it would turn around. Or maybe that rising panic that is just going to keep falling? Yeah, that is the world most beginners live and breathe in.
And right from that emotional place, that's when they make a huge decision. They decide where to put their stop loss, their escape hatch if the trade goes south. And a lot of the time, it's just some random round number, or maybe it's at the absolute maximum amount of money they can stomach losing.
And right there, that's the fundamental mistake. The stop loss is being placed based on a feeling. But here's the hard truth. The market could not care less about your feelings. It has no idea how much you can afford to lose or what your personal pain threshold is. This whole approach, it's reactive, it's all over the place, and honestly, it's just a recipe for disaster.
All right, so what about the pros? How do they do it? Look, they feel the exact same things. Fear and greed, they're universal, right? But here's the key difference. They do not let those emotions call the shots. Instead, they have a system, a set of rules that's built on pure logic.
The action itself is actually identical. They're still defining their exit point before the trade has a chance to go really wrong.
But, and this is a huge but, the foundation for that decision, completely different. See, professionals place their stop loss based on the market's own structure. Their decision isn't coming from some internal feeling, it's based on an external, objective reality. It's based on the story the price chart is literally telling them. And that key structural point, well, it has a very specific name.
And that brings us right to the core principle of a professional stop-loss strategy. This isn't just some random safety net we're talking about. No, it has a very precise job, and it's located at a place called the invalidation point.
Now this idea, it reframes everything. Think about it. Every single trade is basically a hypothesis. It's you saying, okay, I believe this stock is in a strong uptrend. The invalidation point then is the exact price where the market proves your hypothesis wrong. It's the market looking you in the eye and saying, objectively, hey, that reason you got into this trade, it's not valid anymore. And that, right there, is the only truly logical place to put a stop loss.
Okay, so that's the theory, right? But theory is one thing. How do we actually apply it? Let's take a look at how this all builds into a practical strategy you can actually use when you're looking at a chart.
This breaks it down perfectly. What is an uptrend? It's just a series of higher highs and higher lows. So your trade idea, your hypothesis, is that this pattern is going to keep going. So the big question is, where does that idea get proven wrong? Well, it's the moment the price breaks below that most recent high or low. That is your structural invalidation point. And the exact same logic just works in reverse for a downtrend. Your stop goes just above the most recent lower high. It's simple, it's logical, and it has absolutely nothing to do with how you're feeling that day.
But of course, there's a catch. Even when you're using structure, there's this kind of Goldilocks problem. You can't just stick it anywhere. Finding the right spot is a real balancing act, and if you get it wrong, well, that leads to two very common and very, very costly mistakes.
So, mistake number one, placing it too tight. You pick a structural point that's just way too close to your entry, and the market's normal everyday random wiggles, what traders just call noise, ends up kicking you out of a perfectly good trade right before it was about to take off. Then there's the other side of the coin, placing it too wide. Now your trade idea might be totally solid, but the amount of money you're risking just becomes way too big. The potential loss is it's out of proportion with the potential gain.
All right, this brings us to the final, and maybe the most important piece, the philosophy behind it all. We've talked about the what and the how, but now we need to talk about the why. And this is a complete mindset shift that turns the stop loss from a tool of fear into a tool of genuine power.
When you strip away all the charts, all the indicators, all the complexity, the real job of a stop loss is incredibly simple.
Seriously? That's it. A trader's number one job isn't even to make money. It's to protect the capital they already have, so they can stay in the game long enough to win. The stop loss is your chief of security. It's your shield. It's the one thing that guarantees that no single bad trade can ever wipe you out. And this is the ultimate mindset shift. Losses are not the enemy. They're just a guaranteed cost of doing business when you're a trader. The pros? They don't try to avoid losses. They control them. They decide ahead of time with a totally clear and logical mind exactly how much they're willing to pay to find out if their trade idea is right. That is the very essence of professional risk management.
So, I'm going to leave you with a question to really think about. Take a hard look at your own trading. Is your stop-loss placement a reaction to fear, or is it a proactive, strategic decision based on the market's actual structure designed to protect your capital and control your risk? The answer to that question? Well, it'll tell you everything you need to know about the architecture of your own trading.